Hello and welcome to Trading Coaches Playbook. This is Brandon Wendell, joined by Lucy. Here's Lucy. Say hi. She doesn't care. Not very. Yeah, she doesn't care about the camera. Anyway, she wanted to sit on my lap. She was whining a little bit, so I figured I'd pick her up here. Anyway, this is Brandon Wendell. Welcome to Trading Coaches Playbook. We'll go ahead and kick this off. We've got a quick reminder that we're going to look at the markets potentially, and we are doing that from an educational standpoint. We're not telling you to buy, sell, or hold anything in particular, or giving personalized recommendations about the markets. All markets do involve the risk of loss. That is always a situation. No matter what we do, we can never eliminate that risk. We just try to minimize and manage it. And we're not subject to trading restrictions. We can have positions in a security or initiate them at any time. So, good afternoon, Kevin. Welcome, everyone. Like I said, this is the Trading Coaches Corner, and my session for today, I figured I'd talk a little bit about how you can actually kind of protect your portfolio, because obviously the markets have been taking a bit of a dive recently. And before we get into that, you can stay in touch with us. We got a lot going on here at Wealth Builders HQ. So we got a bunch of premium online workshops, as you can see on the left, Trading You, Mastering the Trade, Covered Call Explorer, all kinds of stuff. Go back. I'm actually involved in the E-mini think tank on a regular basis. You can see Monday, Wednesdays, and Thursdays from 9 a.m. to 11 a.m. I host a educational trading session where we look at the futures markets. And that's kind of what we're going to be focusing on a little bit today as well. When we talk about trying to protect our portfolio and see what we can do. But if you want more of that kind of information, you can join me there. And I have not just live sessions, but if I go out, let me see, am I logged in right now? Hopefully. No, actually, yeah, I am. Good for once. All right. But I'm on the wrong page. Anyway, if you go to the E-mini think tank, you'll see that there's education along with the live sessions. So if I go to my E-mini think tank, take a moment to get there. But we meet every week, 3 times a week, and all the sessions are recorded. And basically, there's bonus videos that are educational, and these are getting re-recorded and reorganized. There's documentation that accompanies everything. There's actually a document on what is in here and the order of what to watch these, but we got fundamentals covered, individual trading strategies, charting techniques, and other things as well. So when we're looking at some of the fundamentals, I think might be, I have options on futures right there. We're going to talk a little bit about that. And like I said, a bunch of other things today as well, because if you take a look at the markets right now, and I'll go out to a daily time frame and just back to normal, you can see that we've taken a bit of a dive here recently. A couple of weeks back, I did the Trading Coaches Playbook with you guys, and I was talking about where the markets might be going. Well, I said they were going southbound, and sure enough, here they are. If we go from the high that we have achieved down to the low that we achieved, let's see, does it show the percentage? Oops, where is it here? Template, no. Settings, that's what I wanted. Percent change, that's what I needed. And you can see we've dropped about almost 15% from the highs. Now, that's not bear market territory. Technically, bear market is 20%. But if you take a look at what's going on with momentum right now, this is the RSI that I typically use to help with momentum. Currently, the RSI is below 40, which is a bearish situation. The trend is decidedly bearish. And this is a small retracement, which looks like it might be ready to continue. So if we were to take a look at the retracement here, you can see we retraced almost exactly 23.6% of the preceding impulse, which is a very weak retracement, suggesting that continuation is on the books. And we're starting to get a little more red than green. We actually only had 2 green candles together at the most. And if we go from the high to the low, and actually, you know what? I should do it this way. NQ continuous contract. That'll make a lot more sense. You can see I have done this in the past, but going forward, there we are. Again, we're very, very bearish, but looking forward, we can see, number one, looking back where there might be some pausing points based on supply and demand. And right now, you can see that this was kind of a basing area in the past, but tested. So that means we're more than likely to be able to break through that. As you can see, this is just a pause. It's a correction before we potentially continue. we're in a nice channel. That's also a good sign that this is a correction, because typically you get those uniform looking channels in corrections, whereas impulses are much sharper. You can see, yeah, it's a little bit of a widening, but overall, this is contained in that nice channel there, as you can see. So the next move down, let's go actually to a weekly chart and not mess around, just go to the big picture here to see where are we likely to head to. Um, oh, that's really weird. I don't know, Barry. I have to check on that. Yeah, I'll have somebody check on that link to see what's going on there. Um, hmm. Anyway, you can see on the weekly chart, let's reuse this one right here. This is our weekly demand, which is the stronger one that we should be able to stop at. And this is suggesting we're going to go way to the bottom because, first of all, we've already gone through there before and bounced. So even this is not necessarily the first or fresh origin of the demand. You can see that that may have been a retest of a prior area. Whoops. So going back further, even here, that may simply be a retest of a prior area. But those are possible targets going to the bottom of those two zones. If we're looking for anything fresh, meaning the untested area of demand that's likely to halt prices from declining, we may not reach it until right around this 15,235. There could be something in here as well. Obviously, lots of buying pressure starting in that area, but actually, yeah, we'll move that there. Those are the weekly demand targets, and you can see it's 127.2% of the preceding impulse. So right in line with fresh demand and the projections. So you get that confirmation kind of getting an overlap with those two technical tools. Going down to the daily chart, and by the way, the ES is going to be identical. The Dow is not as weak, but it still is weak. So going back to the daily chart again, trying to find some areas, it's pretty much matching up. There may be a little bit of bouncing a little before. I think it was come on. Can't seem to draw correctly today. There we go. 17.5. And I thought, well, no, 18,000, that is actually a tested zone multiple times. Could it be a little support? Yeah, it might slow us down a little bit, but ultimately the weekly zones are most likely going to be the downside targets. And oh, come on. There we go. Copy that. And there's our next demand. So what are we going to do? Well, if you have a retirement account, it's not as easy to go in and out of those retirement accounts as it is in trading accounts. Obviously, trading accounts, you can liquidate positions that might be affected by downward moves in the overall market. So you protect yourself. But, suppose you have a retirement account, we're not able to make changes maybe once in a quarter, and you want to be sure that you are protecting yourself, but you also are afraid of missing out on the next big move. You want to be able to participate in that. Well, you can create a hedge. But there's several different ways of creating hedges. The most common way that many people do, which may be the easiest, but also not necessarily the cheapest, you got to pay for insurance. You get insurance on your house, you pay a premium. You get insurance on your car, you pay a premium. You get insurance on the markets, you got to pay a premium. But the most common way that most people do this, let me shrink that down a little bit. We don't need that big a font. But most people do a simple thing is on individual stocks, they buy a put. And basically, puts are insurance contracts. That's all they really are. If you think about it, you buy an insurance policy for your car. If your car is wrecked, you are reimbursed for the value of your car prior to it being wrecked. Obviously, it's what their value is, not what you think it's valued at. But anyway, that's what insurance policies do. They reimburse you, make you whole back to the value of that product, whatever it was, before it declined in value. Well, a put option is a contract that allows you to, again, ensure a position in the market. You could buy a put on a stock, and if the stock drops in value, you could sell it at the price it was before it dropped. And actually, let me do this. Oh, wait. No, it doesn't matter. I can use different products. I'll use this one. It opens up. There we go. Thinkorswim. I was going to use TradeStation, but again, doesn't matter. Platforms are platforms. But with this, I can back test with the Thinkorswim. So when that comes up, again, most people do just simply buying a put, which is not a bad thing, but again, you got to pay for it. So what could you do to possibly reduce the cost? Well, one of the things you could do is instead of simply buying a put, you can create a collar. And a collared position is the same thing, buying a put and selling the higher strike call. And the reason why you're selling that higher strike call is it offsets the cost of the put that you are buying. So you're selling something to pay some of the cost. Now, you will not be able to pay 100% necessarily. And the risk you run in selling a call is you get that stock called away. Okay, so you got to decide, okay, where do I not think that prices are going to go above? Or if you're okay with letting go of your stock, then that's fine. But for instance, if I go to, where's my, not open up yet. What's going on here? There it is. So let me just open up a chart here. Come on, no. And let's see. Here's a stock that's been going down quite a bit recently. Anyway, not making any political jokes anymore or anything, saying anything about it. I'm just, factual. It's a nice big drop from 500 to 250, 50% drop. So if you own the stock and you were worried about continued drops in price, whether or not it will, who knows? But again, we see that we are in consolidation right now, right around that 243, 250 range. And the possibility is that it could drop. I mean, let's be realistic, but it also could go back up. Be realistic. Well, if it does drop, we want to protect our portfolio. We could buy a put. Now, you don't necessarily need to buy a put where it is currently, especially if you just get into a position. What you could do is you could buy a put where you're acceptable or accepting a certain amount of loss. Meaning, if you're willing to take a 5% drawdown in price, set the put 5% down. Not a problem, right? So let's say you bought it at 245. Keep it easy. Times 0.95. That's 232. So basically, you would insure it by buying a put at around 233. And right now, if we were to go out and go to trade, I'll go to Tesla. A couple of things you have to identify is how long do you think you need the insurance? Okay. And let's say we want to insure it for roughly 6 months. So I go out to 6 months. And remember, time is money, especially when it comes to options. The longer you go out in time, the more money that option is going to cost. But here's the key. You do want to actually spend a little bit extra because you think of it as a deposit. What happens is when you have less than 30 days or have about 30 days left until the expiration of that option, you should probably close it out. The reason why is that options expire with time decay. And the closer you get to expiration, the more the value goes down. You take a look at the price of, for instance, the 235 puts right now, about $36. But if you look at this 235, it's only $12. Why is it so cheap? It's the same strike price, right? Well, the reason why is there's a lot more time left in this one. There's less time here. But here's the thing, the time decay is not linear. It accelerates the closer you get to the expiration. So if we go take a look at the options Greeks, you can see that currently my time decay on this 235 put is 37 cents per day. Meanwhile, going way out, it's only 10 cents per day. So I have a very limited amount of time decay if I buy a lot of time, and I can close this out. And if I still need insurance, I can reopen a new position. But typically, if you're going to buy options for that collar, okay, kind of a sub, and I'll put it in here. Little note is that you want to buy greater than probably 45 days to expiration, preferably, 6 months. And then consider closing with 30 days until expiration. They call it DTE, 30 days till expiration. So I have to keep writing it out. You can always reopen a new position again if you need to extend it. But you get most of your time value back because the time decay is not linear. It's very mellow in the first part and then drops off dramatically at the end. You can see how right here I've got 10 cents. If I go to 119 days left, 13 cents. So it only gained 3 cents of time decay in 70 days. But when you go 30 days or less, watch this. We went from 31 with 27 days, 6 days later, 37. So we lost 6 cents in 6 days. Meanwhile, back here, we only lost 3 cents in 70 days. There's a big difference. Okay, so that's why you got to be careful when you're trading options in general. Buying options, buy time. They cost more, but it's worth it. You get what you pay for. Okay, you get a little bit of extra time buffer. And if you sell this before the expiration, you get most of that time back. Obviously there could be intrinsic value, there could not be. Hopefully not, because we're buying this for insurance. So again, we're going to pay $36 for this times 100, so $3,600 to buy this right now. It's expensive, but we can lower that cost. Let me see. Can I go ahead and add in? How do I add in the extra on here? Actually, no, wait a minute. Let's go to analyze. There we go. Add simulated trades. So Tesla, there we go. And again, going out in time, 182 days, 235, I think it's the closest we can get. So I'm going to buy that one. And at the same time, I can sell a call where I believe that prices are not going to reach. And probably not over 300. If we do get a rally, even if it does get to 300, if I bought at 245, that'd probably be a nice profit. Oh, I'm sorry. I wanted it. Yeah, did I say two? Yeah, 232 was where I wanted to protect. So, all right. So let's go back and add that 235. I'm sorry, not 235, the 300. Oh, need more data. More. So I'm going to have to grab them all. So we go to the 300 calls that are deep out of the money here, and we sell one of those. There we go. So we're doing a combo where I am buying the put and selling the call. And look what happens to the price. It went from a cost of, what was it? No, $3,600 to only $1,000. So that's a lot cheaper. I didn't get it for free, but I got it reduced. And what happens now is if prices were to drop, I could use that put to be made whole again. I could go ahead and exercise my put and sell stock to somebody at $235, even though I paid $245, I take a loss. But if the price is at 200 or less, then I get to sell it for more than I bought it for. That's pretty cool. If the prices go up a little bit, I can go ahead and buy back the put, and the cost is just simply time value. That's all. It's a reduced cost. And if it were to go above 300, that stock could get called away. But since I bought it at 245, I sell it at 300 minus what I paid for the options. I actually walk away with a profit. Pretty cool. The problem is it gets kind of tiresome to monitor each individual position over time and have to do a collar on each one of these. It's kind of cumbersome. So one of the things that we could do is try to figure out, okay, what can we trade that moves similar to similar to this security or securities that we own, especially if you own a bunch of mutual funds, and we could use that to protect ourselves. Well, we have a couple of choices. We could actually do index or ETFs or futures. Okay, so there's several different choices instead of doing the collar or even buying a put on individual holdings, we can create a position on the portfolio, something that'll basically mimic the portfolio. And let's see here. Let's get some more room for writing. There you go. Take screenshots in the notes, obviously. So we can use something to mimic the portfolio and ensure that. And some of the things we have to use to mimic the portfolio, we have the indexes. So we have SPX, NDX, DJIA, and so on, or even the Russell if you're doing small caps. Or we can use ETFs. There we have SPY, UQQ, DIA, and we have futures, ES, NQ, and YM. Or, depending on the size, we have MES, MNQ, MYM. So we have a little bit more of an adjustment there. And we don't only have to do the individual indexes. Yes, you could actually sell an ETF or future. Actually, it's for short. Well, you would sell ETFs or sorry, other way around. You would short ETFs or sell futures. You could also buy inverse ETFs. That's another alternative. So those are a couple of opportunities that we could use to hedge an entire group of stocks or even a retirement account if you choose to. Okay. So that may be a little less expensive because you're basically creating a position. It's easier to track. You're creating a position on one security rather than multiple securities. All right. And that's pretty cool. Now, most people have in their retirement accounts a bunch of what we call mutual funds, right? And let me see if I go out to the Yahoo Finance. Excuse me. And markets. Where is it here? Top mutual funds. There we go. Just to get some examples. Okay, and we can take a look at those. Also, if you're not familiar with the inverse ETFs, I think is it etfdb.com? I think that's what it is. etfdatabase.com. Yep, there it is. So we can go into, is it under tools, ETF screener. Yep, so etfdb.com, database.com, basically. You can go into, no, that's not it. Trying to find the inverse ones. There's a way of finding it somewhere. That's issuer, brand. I don't care about that. Structure. No. And you can see returns. No. I forgot what it is. FANG ETFs, marijuana ETFs. Anyway, there's a way you can search for inverse ETFs. I cannot remember what it is. Now, I'm not going to spend too much time on this anyway, but you can go in there and you can find them. That was under structure, but maybe it's not. Oh well, there's a lot of things you can look for. And you can actually screen through these to find better opportunities. But yeah, you could buy ETFs that move in the opposite direction of the particular market. And I don't see any right here for now, but they'll pop up, I'm sure. Anyway, what was I here? Getting back. The other thing that we can do to leverage this is instead of trading the actual ETF or the actual futures contract is we can use options on the index, ETF, or future. Can be cheaper, but you have to basically know how to balance it out. What we're trying to do when it comes to protecting our portfolio is we are hedging. And if you're not familiar with the term hedging, let's go with that color. That didn't work. Hedging is basically offsetting risk using a different security. And what most people do is what's called delta neutral or delta neutrality. Basically, one share of stock equals one delta. And that's the Greek term delta. So what happens is if you are trying to go delta neutral, you've got to create a position that has a negative delta equal to the positive delta in your portfolio. So going back to my Tesla example, if I go back over to my charts here and my trading or analyze, excuse me, if I go into this, there we go, delta. Remember, one share of stock has a delta of one. So let's say you own 100 shares of stock. Your delta is 100 on the positive side for Tesla. So if we wanted to protect ourselves 100%, you would have to have a negative delta of negative 100, right? It makes sense. So again, as an example, 100 shares equals 100 delta. You may see the symbol sometimes. The symbol for delta is just a triangle, basically. It's a Greek letter. So what you need to be delta neutral is a negative 100 delta. That may be one option. It may be multiple options. It depends on which option you choose. If you recall, I was using Tesla and 235 puts. Taking a look at the 235 puts going out that time, the delta is negative 36. And it's 0.36, by the way. So what I really need is, again, that's per share, but each option contract is 100 shares. So that would be a 36 negative delta if you buy that. If you sell that option, you reverse the delta. Okay, so right now, buying a put is a negative 36 delta. Buying a call is a positive 64 delta. And we obviously don't want positive delta, we need negative. So if you sold this, that would become a positive. If you sold a call, that'd be negative. Okay. So anyway, getting back to this, if I have a negative 36 delta, or negative 36 or 100 shares, right? So what do I need to do? I need more than one, don't I? In order to be completely delta neutral or closer to delta neutral, I need to balance this out. 100 delta roughly equal to 3 puts. And let's see. I'm not going to do the math in my head. 36 times 3, 108. So again, it's not equal. We have a little bit of a bearish bias because we have a negative 8 delta total, but we're relatively balanced. And what you have to be careful of is this will change. It's not static. The closer you get to in the money from being out of the money when it comes to these options, take a look at what happens. Notice the 235s, we're currently trading at 245. The 235s are negative 36 delta. 240s are negative 37. 245s are negative 39. Why? The closer you get in the money, the closer you get to 0.5 delta. So you may actually have to close out some of your hedge as the markets drop. You won't need as much, or you can keep it and get extra profits if you need to when your portfolio is dropping. But to remain completely delta neutral, typically you have to make some adjustments, not every day, maybe check it once a week, once every couple weeks. Okay, it's not like you have to do it right away. It's got to be maintained every single moment. But we can change this now. Remember, if we're doing both, where we are buying. Now let's do this. Where is it? Oh, we had the delta that we have right here for the put that we are buying -35 right there. But I forgot, we're also doing another one, aren't we? We are doing the call as well. In this case, I chose the 300 call. Well, that's just really going to offset my cost, but it will change the deltas a bit as well. There we go. You can see I actually have a 750 delta, but really the hedge is on the put side that I'm worried about. So I want to make sure I'm hedging it properly. So I do 3 of those options, and then I would buy 3 calls to offset that cost. Sorry, not buy, sell. There it is. Sell the call. Why does this not allow me to buy the put? I don't want to strangle. Let me see if I can do this right. Sell the call. 240, 235. Buy the put. There it is. Combo shows. And my delta is actually -78 right now, because selling that call also gives me some extra negative delta. So I may only need to do one of these for one share of stock. I still have a little bit of positive delta because I'm -80 basically versus 100 on the positive side. But it's a little more balanced out. But again, I don't necessarily need to do all that. Instead, what I could do to protect myself is I could figure out what my entire portfolio is worth. But instead of doing delta neutrality, we may want to hedge using something different called beta neutrality, because what this is not taking into account, Tesla does not move one to one with the broad market. So if I'm using, let's say, the Nasdaq or the S&P as a hedge, I need to see how volatile that individual security is versus the broad market. That way the hedge is not correct right here. Okay, so basically what we need to do is change this around a little bit. Instead of delta neutrality, we want to do beta neutral or a beta hedge. And the reason why is the volatility of the individual stock. In this case, I'm using Tesla. Let's see what it is. Oh, I was in the right spot here. Let's go to not mutual funds. Let's just go to Tesla. Individuals, now not Tala. I don't know what that is. Tesla. There we go. Tesla. You'll see beta. There it is. Keep accidentally clicking the wrong things here. Anytime you get a quote for a stock, you usually see beta listed, and there it is right there, 2.51. Is that not on? No. Anyway, you can see it if I zoom in a little bit, perhaps. There's beta. It gets shown on most websites, financial websites for different securities. Okay. That 2.51, what does that mean? That beta means that Tesla is 2.5 times or 250% more volatile than the broad market S&P. So if I were to try to use a hedge of, let's see, I'll go back here and I'm going to keep that chart. Let's use this one. Actually, I can just use SPX, the index. Here we go, on a daily chart. And then I can compare it to the stock. There we are. And let's see, we'll change this to a line chart as well, just so we can see the two against each other. And we're going to get rid of the indicator because we don't need that now. But take a look at this, securities. Notice if I'm using the S&P 500 to hedge Tesla, Tesla's moving down much faster. Let's see, this started declining in December, didn't it? Right there. So if I start comparing these from that time, there it is, zeroed out. Tesla dropped 48.86%, while the broad market only dropped 6.72%. So if I tried to buy puts on the S&P 500 thinking I'm hedging my drop on Tesla, I'm not. That stock is a heck of a lot more volatile than the broad market. I can do the same thing if I take a look at the NASDAQ. Let's do, instead of SPX, we can do NDX, NASDAQ 100 index, and see the same problem. From that same date, the NASDAQ's only down 11%, while Tesla's down almost 50%. So we need something that's going to be more balanced and actually hedge. And that's the beta. We got to take a look at the beta. Remember, the beta on Tesla, 2.51. That means it's more than twice, 2.5 times more volatile than the broad market. We need to beta weigh our portfolio. Now, depending on which brokerage you're with, there's actually a way of beta weighting. I think it's under here. Nope, it's not there. Where is it? Well, I don't have any positions right now, but you can beta weight pretty easily on Thinkorswim. There's some buttons to be able to do that and just beta weight it out. And I think you can actually do it on TradeStation now too in the options section. But basically, we need to figure out what is our beta of our portfolio. Now, if we're trading mutual funds, they have betas as well. So let's go back to top mutual funds. And here we are. I don't know what any of these are. It doesn't really matter, but let's click this Thornburg investment. Income Builder 1. Okay, it's some sort of retirement fund. And you can see the beta is 0.92. That's pretty close to 1. If you have a beta of 1 or less than 1, that means your security is going to be just about as volatile and move with the S&P 500. That means one insurance policy on the S&P 500 basically insures 100 shares of whatever stock you happen to own. Okay. However, let's see if we can find something a little more volatile. This one's not bad. You can just do 1-to-1. But if we find something that's very volatile, let's see, Tortoise Energy Infrastructure. Nope, again, beta is very low. Might have to screen through, or I can go back to that ETF database, maybe find some ETFs that are volatile as well. But let me see. 3-month return. Can I sort by that? Yeah. No, that's 0.88 again. Mutual funds are not necessarily that volatile, although some are. Some are going to be much higher. I just got to have to find some. Energy infrastructure is probably not going to be. Oh, here we go. Euro ultra sector. There we are. That probably will be because it's an ultra. Yeah, slightly more volatile. This is the ultra energy sector, 1.33. So it's a little more volatile than broad market. What you really have to worry about is individual stocks. If you own a lot of individual stocks like Tesla or Amazon, basically you've got, Amazon's not too bad, 119. Okay, Tesla we saw was pretty bad. Netflix, what do we got? 1.38. Again, it's more volatile than the broad market. It's not too bad. Apple, what do we got there? 1.18. So definitely not as bad. But if you have some high flyers, you definitely need to protect yourself and beta weight. Oh, NVIDIA, that's the one I was thinking of. Yes. That should be much higher. Not by much, 1.76%. It's because it's one of the bigger pieces of the index. When you take a look at some of the, let's see, the makeups of the index, for instance, and the only way you can really do it, not looking at the index, it's easier to look at SPY, the ETF. You can look at the holdings of it. And by looking at the holdings, you can see Apple is 7%, Microsoft, NVIDIA. These are the big players. So they're going to be tied to the broad market. They're not going to be that much more volatile than the broad market because when they move, they'll move the markets for the most part. Okay. So that's not a big deal. But some of those high flyers, you do need to beta weight your portfolio properly. And the same thing if you have a mutual fund or ETFs that have high betas. So the calculation, I actually have a calculator I created a while ago. Got two. This is the simple one that I started, and it's actually got a sample in there. And basically what you need to do, clean that up a little bit. There we go. You got to figure out your portfolio beta. And it's actually relatively simple. So here, this is a one I did a long time ago. You can see I had PTCIX, VTTVX, VGSNX. These were ETFs, or not ETFs, these are mutual funds that were actually in a student's portfolio that I had, that I saw. He shared it with me. And the number of shares that they had purchased, the cost per share. So it shows the cost basis, basically multiplying the number of shares times what they paid. This is where it gets interesting. Here we have the beta of that security. And what we need to do is figure out the beta weighting of the portfolio. And there's simple calculations. Like I said, I actually did it. I worked with the inner circle here at Wealth Builders HQ, and I created a little bit better one. So I could probably transfer those numbers over here. I'm going to do that real quick. This one's a little bit cleaner. And no, I'm not sharing this with you guys right now. I will share it with my students in the mini think tank because I also teach the strategies a little more in detail on how to hedge yourself. But V, G, S, and X, F, G, C, K, X. You can tell it's a mutual fund because the last letter is X. F, L, C, E, X. There we go. And I'll do it this way: 1,000, 200, 800, 450, 700. Cost basis, and it's cost per share. So that's what I have right there. So that's 12.15. Hang on a sec. Oh, sorry, 12.45. 15. Oops. Type today. 14.95. 122.18. I don't even know what the prices are right now. 11.67. So there's the, obviously it's just multiplying right there. And then the beta for each of these securities, I would look them up like I did just with the individual stocks. 2.27. And it automatically calculated the weighting in the portfolio and the beta weighting based on that portfolio weight for my portfolio. How cool is that? So again, I just did all the calculations and it's worked it out in the spreadsheet. Anyway, let's see what else we have here for the beta. We got 1.08, 0.64. That one's very, very quiet. 1.24. So they only have one that's really, really volatile and a couple that are on the border there. But that's 100% for their portfolio, should add up to 100. There it is. Portfolio weighted beta, the entire portfolio is only 21% more volatile than the broad market. And there's the number of shares, there's the cost basis, there's the portfolio beta cost basis. And basically, we need 121 negative delta to hedge that portfolio. So how do we get 121 negative delta? Well, a couple different ways. Okay, as I mentioned before, one of the ways we could do that is go out to delete these. There we go. We go out to, let's say, SPX, and that's the S&P 500 index. We could go ahead and buy one of the, or sorry, short one SPY. That's one way of doing it. Or sorry, not one, 121 SPY, right? Because remember, each share of stock is 121. Or sorry, each share of stock is one delta. Okay, this is where the negative delta, it's a calculation. It's actually showing the beta weighting and then adjusting for the delta. It's multiplying the beta weight by 100 to give me that delta weighting. Because I'm 21% more volatile, I need 121 negative delta, right? So if I go to trade and not the option, but the actual security, you go out here to SPY. Right now we're trading at 562.44. So if I decide I'm going to sell, I'll just do it with a stop loss, doesn't matter, but I'm going to sell short, oops, 121 shares, not 12,100, sorry, 121 shares. That's what I wanted. That is a negative delta of 121 shares. Let me get rid of, delete. There we go. Just do sell. I did 100. Edit. There we go. Nope, it's going by hundreds. Anyway, 121 shares short would allow me to do this. But here's the problem. My buying power is going to be reduced by $34,455. That's what it's going to cost me to insure my portfolio. Well, what was the value of that portfolio? That portfolio cost base is $63,000. I don't want to spend 50% to insure it, do I? That doesn't seem right. Even if I do, again, that's shorting the stock. That's why we use options or even futures. Now, if I want to do futures, I've got a couple choices. First of all, I cannot really do the ES. And here's why. If I do ESM 25 and I decide to sell again, no, I'll just do sell one. There we go. Single, edit. If I sell one contract, okay, that is the equivalent of 100 shares. But the problem is, again, the cost is $16,000. Not bad, but I'm not truly hedged, am I? Because in this case, oh, where is it? There it is. Come on. Okay, so the alternatives that we're looking at. Right, yeah, do this. Short SPY, and it was 121 shares. Again, it was roughly what, $34,000? Too expensive. That doesn't make sense. We could sell one ES, and that's only what, 16,000 roughly. Now that's margin. We actually get that money back when we close out the position. So it doesn't necessarily cost it. Okay. But it does tie up capital. That's a little bit better. Again, what was our portfolio worth? 64,000, we'll call it. We're still spending quite a bit of money for insurance there. 25% of our portfolio for insurance. It's a little expensive. I don't want to pay that much. So, and also that is not really delta neutral. The problem is we will still have a positive balance of 21 delta, because that's only going to be a negative 100 delta versus the positive 121 delta that we have. What if we sell MES? Well, we could do that and get it a little more accurate. But again, the cost is going to start to be a little bit prohibitive. So we could do one of the full size and maybe 21 MES, but again, it's costing us money. Delete this. MESM. Sell, single, edit. Add the extra 21 micros, and that's an extra $1,600 on top of the 16,000. So again, we're about 25% of the cost. Still kind of prohibitive. So instead, we could actually look at the index and do the options on the index. MES, that's the micro version. That's all. Micro MES is micro ES futures. So what happens with this, you see, if I go here, the ES is a quarter point movement, and each quarter point profits or loses $12.50, and the margin is $16,000. The MES is 1/10 the size. You can see every quarter point profits or loses $1.25, and it's $1,617 per contract. So that's all it is. Instead of basically, it's one net delta for each MES versus the 100 delta for one ES. Okay. So that's how I can get 121 negative delta. I do one full size and 21 micros. And that would actually be neutral then, because for every point we go down in value altogether on the portfolio, we would profit in the MES and ES position that we were short, and it would cover what we lost. And you could do futures, by the way, and even futures options in retirement accounts. TradeStation, I know, offers futures IRAs, self-directed IRAs. I think they might have them in Schwab as well, but I'm not positive. Now, the alternatives I just said would be to do the index instead. If we go out and trade options on the SPX, now we can lower our cost by buying puts on the index. And again, we just have to make sure that we're delta neutral. Well, since we did our calculation and beta weighted our portfolio, we found out exactly how much negative delta we need, 121. So going out again, enough time. This is on the index here. To go way out a bit. There's 181 days. And we can wait for a little bit of a drawdown in the markets. We don't necessarily need to hedge from where we are currently. If we're willing to take a 5% drawdown before we start insuring ourselves, again, we can set that up. We can see what a 5% drawdown would be. But of course, you've got to make sure you multiply by the beta to make sure that 5% drawdown in your portfolio is not equal to a 5% drawdown in the markets. So there's a little more work to this. But if you do it right, you can protect yourself for a fraction of the cost. So let's say if we drop below 5,500, we want to make sure we're protected. Well, sorry, let me go back. Trade or analyze will do that. And actually, let's do this. A little more fun. We started seeing that drop in the portfolios coming back in, what day is this? February 20th is where this market really started dropping. So let's say we put on the hedge a little before that. Let's say we did it February 6th. And we were worried about a drop from, we're about 6,100 back then. Let's say 5,900. We want to protect ourselves from a drop from 5,900 and below back in February. I go back to analyze. Let's go to think back. Again, SPX, the index. Not going to let me see them. There they are. I was going to say, it should be. Great. And go to that date. Let's do February 4th, right around that time. And basically go to the options that expire 6 months out. Well, we got 177. That's close enough. Or we could do the August 25. We'll do those. And you know what? Let's do 59.50. That's close enough. I don't need to go all the way. So I got 59.50 puts. And that is a delta right now of -40. So what do I need? Well, I need to add to that. This is going to be a -80 delta if I did 2, right? I don't know why it's not calculating, but negative. Delta. You can see right there, the 59.50s on that date, which we were trading at 59.94, it was a -41 delta. So to do, well, again, we're not going to be able to get it exact, but to get close, we could do at least 2. And this delta will grow as prices start dropping anyway, so we'll probably be okay with that. So now I have a -82 delta, but it's going to cost me, why is the price not showing here? I don't know why it's not loading up right now. Try this again. Really weird. Yeah, so let me do 59.50. So I'll just do, the heck is happening here? Oh, that's the AM options. That's why I didn't want those ones. That's a problem. I'll do these weeklies. There we go. No, this is in the past. I'm doing a back testing. Of course it's past. Yeah. So there we go. We'll do this 59.50. There we are. And again, I've got a negative delta of 41. And now I've got a -82 delta. If I try to do 3, I've got 123. Well, what do I need? Actually, I'm sorry, I need a -121, don't I? I need 3 of these because there it is, 121 negative delta, 123. Now I'm delta neutral. The problem is this is going to cost me 19 grand for 3 of those index options, right? Now, how do I reduce that cost? I can sell calls against. I can create a collar on this. So if we go to my chart back then, again, back in February, I might have been worried about this rallying, or again, I'm worried about dropping really, but I might be willing to get out if it hits 6,300. I can go ahead and create that collar at 6,300. Yep, I'm gonna need more options and reduce my cost. Come on, maybe not go that high, but we'll see. Let's do 6,250. There it is. So I'll buy, nope, not buy, sell 3 of the 6,250 calls. And look what happened. It reduced my insurance now to 4,265, but I have too much negative delta, don't I? So I don't need as many. We reduce, reduce. Yep, let's see. One is negative 82, negative 161. If I want to balance it out properly here, I can do sell 1 call, buy 2 puts, and I'm at negative 122 delta. There, I'm actually neutral, but it's still costing me money, $23,000. If I do 2 and 2, I have a little bit extra protection, but it's only going to cost me now $4,200 to protect that portfolio. Now, it really won't necessarily cost me that much because I'm going to get a lot of this money back. Watch what happens. First of all, let's say we did, again, this is $64,000 portfolio insured by 4265. That is now 6% to pay for the insurance. And I'm delta neutral. I will not lose money if this market drops. Watch why. Okay, so if we start going forward in time, what's happening with our profit and loss open right here? Can I adjust this at all? Allow me to adjust these or slide them over. Anyway, you can see there's my P&L. The markets haven't really dropped yet. It's on a weekend. Come on. That froze. Oh, no, don't do this to me. Why is it freezing? Of course it is. Anyway, if I keep going, what'll happen is this profit will pick up and offset the loss that I'm having from the markets dropping. But for some reason, the program just froze on me, and I don't know why. Anyway, that's one of the things that we can do. I've reduced my cost of protecting myself, and I can do this also with the futures. I don't necessarily have to do it with the SPX. I could have done it with the MES or the ES, and the options on the futures doing the exact same thing, creating that negative delta that protects me. And again, I don't know why this froze. It's weird. But as I go forward, the loss that I would have in my portfolio would be offset by the gain that I have here. That's pretty cool, isn't it? And it's all a matter of knowing how to balance out your portfolio properly, which it's not too hard of a thing if you know what you're doing. So I'm going to have to call it here because I've run out of time and I got to get going. But hopefully I shed a little bit of light on some of the opportunities that are out there. And basically for the best hedge, as I was saying before, we can use options on the index or futures. The reason why I like index on the futures is in order to trade futures, you use leverage. And in order to trade options, you use leverage. So options on futures is actually leverage on leverage. And I could probably reduce the cost down to about 3% of the portfolio. Okay. This will be posted, I believe, in our YouTube channel online once it gets all put together. I think there is a YouTube channel for Wealth Builders HQ, and I think on our website as well. But yeah, this is not something a lot of people talk about, but it's something that's very, very useful, especially in bear markets, which happen. So being able to protect yourself against those adverse moves in the markets, definitely very beneficial, isn't it? And I was trying to get my program back up again on the toss, but for some reason, again, it is completely frozen out. So sorry about that, guys. I was going to try to show you the results, but trust me, it actually works. I've done it in real life. So anyway, I want to thank everybody for being here. If you want more information, you can always email us, support@wealthbuildershq.com. And if you want to learn more about all this, join me in the E-mini think tank. Let's see, wealthbuildershq.com. There you go. All right. So again, happy trading, everybody. Yes, thank you. Trade safe, trade well, and take care, everyone.